Hi, I'm Lauren Saidel-Baker, and thank you so much for joining us for this June 12th edition of FedWatch. We're doing a data dump this week. You might have noticed that last Friday we didn't talk about that blowout jobs report. That's because we wanted to get some CPI and PPI numbers this week. We're going to put everything in context all together and then end with some global news about the ECB. So let's start flashing back to last Friday. We got that May jobs report. Huge headline beat, 172,000 jobs added. But what was the breakdown there? First of all, it was led by hospitality, which is an interesting one at about 70,000 jobs gained. So that's a pretty good benchmark. We do like to see these gains coming in a variety of industries. But where we have seen very strong gains recently and where we again got a pretty um, good result coming out of the May report was in things like government. That was 55,000 jobs added, and healthcare at 35,000 jobs added. So, still very strong contributors from some of these less macro associated or less macro correlated sectors. In May, unemployment rate held steady at 4.3%. We did, on top of this very stellar number, also see upward revisions to the past 2 months of jobs reports as well. So, overall, this was taken as one sign in the hold rates steady or even increased rates column. This was not a move or some impetus to see rate cuts. Let's compare that to the inflation data that came out this week. We got both CPI and PPI. On the CPI front, up 4.2% in May. That is also a very big number. Again, much of this rise was concentrated in the energy price side of the equation. However, even core CPI, excluding the volatile food and energy categories, those were up 2.9%. So it's not only oil prices that are causing this inflation. We've been talking a lot about that, so I won't really extend on that point for too much longer. Compare that to the PPI number, 6.5%. Again, very elevated, much of it on the energy increase, but other factors are still out there. So please don't think this is only oil prices. There are very, very fundamental inflation drivers, and we are still seeing those come through in this more recent data, even if it's things like higher energy costs that are really leading the narrative. So, how do those two factors, jobs last week, inflation this week, how do those complement the two sides of the dual mandate that the Fed is looking at? Well, in both cases, this was again a tick in the column of we need to either hold rates steady or eventually even start to see rates increase from this point forward. Neither of these reports, neither of these factors would argue in the column of cut interest rates going forward. We're seeing that reflected in market sentiment. Next week's Fed rate decision, almost 100% odds that we will not see a rate change. We at ITR are very much in that camp. No rate change expected in the near term. But what we're really starting to look at is odds for later this year and into next year, showing more signs of life in the rate increase category. I've been saying for several months now, if you've been with us here on Fed Watch, that I would not be surprised for that next rate move to be up instead of down. And I think we're getting firmer and firmer in that camp as we do get stable signs from the labor market, as well as these signs of increasing price pressures. All of the inflation data right now is showing that. And again, this is for more than just transitory issues. This is not only the war in Iran, the conflict in the Middle East. I know we hate that T word transitory. The Fed, Federal Reserve, Fed officials have been burned by it in the past. But let's keep this all in context. What is a fundamental inflation driver that is not going away, even if, say, the war were to end tomorrow? I also want to loop back to some global news. This week, in fact, on Thursday, we saw the ECB raise rates by 25 basis points. This was their first rate increase since 2023. In that decision, they very clearly cited the Iran war. They cited the impact of oil prices on inflation. We do see Europe hit a little bit harder on the energy cost front compared to the United States. We're slightly more insulated here, even though oil prices are clearly a global commodity. We are all trading on that global scale. Interestingly, the ECB also raised their inflation outlook. in this same timing on Thursday, and they revised their growth forecast down. They're now expecting just 0.8% overall growth in the EU in 2026, rising to 1.2% in 2027 and 1.5% in 2028. Now, if you follow our ITR forecast, please go into the trends report. You can see the 3-year outlook for both Western and Eastern Europe. We divide it up a little bit differently than just Eurozone, EU overall. But these are slower but still positive growth rates. We're expecting a little bit more malaise out of Western Europe coming into next year. Please do watch those markets very carefully. If this is a market you're very exposed to, take the directionality of moves from the ECB today and talk to your ITR economist about this because we do have more specific, more granular forecasts that you can use for your planning as you are looking at your market by market exposure in Europe. But overall, 25 basis point rate increase. Heading off that inflation, we will see. I don't think 25 basis points is enough to turn the ship around, but it is a move in that direction that I personally will not be surprised to see the US head in following. As always, we'll be following the Fed meeting next week. We'll be talking about their rate decision or indecision, as the case may be. Please come back next week as we unpack all of that news. Until then, I'm Lauren Seidel-Baker. Thank you so much for joining us on FedWatch.